Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about, see the articles, see the news flow, and I'm going to give you my financial opinions around that news flow of where I think we are in the cycle, in market analysis, how this fits into the bigger picture, all of those things. And if you want to follow me on Twitter, you can follow me at finding_finance, or you can join our community at finding-value.com. Use the word discount and the coupon code to see how I'm positioning for the commodity bull market and what individual stocks I prefer. So here's this couple here. They've been pretty active in my feed on Twitter, and they've been obviously trying to grow their presence on Twitter. That is quite obvious. And they keep throwing out all this information. They say, we collect $135,000 a year of rental income. How we got here in less than 5 years. I can tell you how they got there. They are very leveraged. And the more you leverage up, sometimes it works. Sometimes you get absolutely slaughtered and go bankrupt. It depends on the market conditions. They put very little money down. They try to cash flow the property, and then they use the cash flow to gain equity in other properties. But it is a very leveraged way to play it. And sometimes that works. Sometimes it ends in bankruptcy. That is what a lot of real estate people have done. They have leveraged way up and run the risk of bankruptcy if something doesn't go their way, or if the market goes against them. It is a dangerous proposition, but if you catch it during the right market cycle, you can be right, and you can make a lot of money, and you can rent those properties out, and you can cash flow it and pay off those loans, and eventually own all the homes over time. So I just wanted to make a comment there that what they're doing is risky, and what they're doing very well could work out for them, given where we are in the cycle. And I hope it works out for him. I really do. Now here's Joseph Brown. He's Heresy Financial. I think he actually gets the housing market, which it's good to have a couple of allies on the housing market bull camp. He says homeowners can't afford to sell because they would have to rent for more or buy for a lot more. Home builders are the winners here, providing inventory to a supply-starved market. Joe, way to go. I agree there. It says U.S. new home sales unexpectedly rise to a more than 1 year high. So this article here, we're unexpectedly rising to more than, it's not unexpected for me. I kind of expect this to happen. But at least he's reporting some good news there. We've got John Hinster, knocking on heaven's door. Hey, and there we go. We're right on resistance, knocking on the resistance trend line. Hopefully we can break through it. That's for Cameco and the uranium sector. The uranium sector has firmed up a little bit here. Again, I think it's highly tied to interest rates. It's as if the hedge fund guys and banks have written programs where if the interest rates increase and invert, money flows into uranium and energy and oil and natural gas. If it uninverts, it's like they've written in the program that the money rotates and moves into precious metals. And that's what we're seeing with the interest rates moving up and down. It does look like the interest rates could go lower, where we could see a little bit of softness in the oil and uranium sector and a little bit of strength in the precious metal sector, given how maybe someone has written some programs. We'll see if that's the case. I would love to see oil and uranium take off to the upside, even when rates go lower. So I'm interested and curious to see how these all react in the short term. We've got Eric Nuttall. He says, energy aspects, steep, visible stock draws will be needed before the market believes in fundamentals and goes long. In many ways, this is a futures market that does not reflect the views of the future, but more the here and now. And this is what he is seeing for a forecast on total global oil held in inventory. A sharp decline in the inventory levels to a level that is very, very low for total global oil held in inventory. That's onshore and floating storage. I know I had a recent interview with Shabam, and he's like, you know what? We're going to have to draw down inventories until the market believes that we have this shortage. And that's what is forecasted to happen. So we'll see what happens. Again, I'm not forecasting that oil prices are just going to rocket higher, but we'll see how the inventories play out, and then we'll see how prices react to those inventory levels. Here's Lance. He says, new Zillow forecast model predicts rising home prices between April 2023 and April 2024 in 390 of the nation's 400 largest housing markets. Wait a minute, guys. I thought that we are going to have a housing bubble and a crash. Why are new home sales going up with an existing inventory that's starved of inventory? And why is Zillow predicting that we are going to go up in price over the next year? Why do we have these dislocations in the market if we're in a housing bubble? Is something being missed by the housing bubble people? I think that inventory is too low. I think it's going to drive new home sales, and I think new homes and new housing starts are going to go up. We can also see that the construction cycle is rather robust and is still adding employees and construction spending to that mix. So I don't see the weakness yet. And if weakness comes, it's going to take time. I think we are still years away from a housing market crash. But it's okay to disagree with me. I am okay being Han Solo and or very in the minority camp, so to speak. But you know what? To be contrarian, you have to be in the minority camp. The majority, at least on a YouTube's perspective and on a Twitter's perspective, is that we will have a housing crash, and it will be monstrous. I am not claiming that house prices can't go lower in the short term. What I am claiming is that new homes being built, the volume of new homes, will go up or remain where they're at today. And that is the construction cycle, and that is the thesis. The thesis is not home prices. It's the volume of new homes being sold, and that is what matters. So if prices go down 5%, but the volume of new homes goes up for sale and they sell, you still get a credit expansion. Now, I know a lot of people are arguing about the M2 money supply that's in decline. That M2 money supply, it matters where that is coming out of the system. It might be M2 money supply coming out of the system through quantitative tightening, where the money was in financial assets. If the money is coming out of the actual system where we're seeing velocity, which it isn't because the velocity's been increasing, that M2 money supply is probably coming out of something else. And it's increasing the velocity of that money that is still in existence, that's rotating in and around the system. So you guys have to look at the velocity of money, and I'll pull it up real quick. Fred Money velocity, and I don't know if they actually, velocity of M2 money stock. And we're seeing the M2 money velocity, I should say the velocity of M2 money, is going up. So here it is. There it is here recently. And look at that thing ramp up higher. They're taking money out of, oh wait, let me move it over here, guys. Sorry. Goodness. There it is. This move to the upside here. This is the velocity of M2 money stock that I've got here. That's moving up to the upside. What that means is that money in the system, they're taking money out of financial assets, is the way that I'm seeing this. And the money that's circulating in the system is remaining circulating, so the velocity of that money is increasing. Basically, they're taking dead money out of the system, and the velocity is moving up because of that. Coming on down, it says copper looking dangerously close to 1997. So 1997, we had a rollover in copper here, and it looks like we could roll over in copper as well. The economy can slow down, and we can still see sales and inflation. New home sales go up, inflation go up, and unemployment go up, all at the same time. Unemployment went up in the 1970s at the same time that home prices went up. And people on Twitter and on YouTube are going to be dumbfounded about that, because you can still be in a housing shortage even when unemployment goes up. Unemployment and the demand for homes are not correlated. They are not highly correlated. I don't know if I need to say that again. Here's another one. Check out my latest interview with Capital Cosm. He asked me to go on, and yeah, I definitely would go on. And if there's any other channels that want me to come on, I'm willing to go on to your guys' channel. Here's GOT Supply. So U.S. shale production is set for a rapid decline. That's the supply side of energy, and energy is a large impact to inflation. We'll see what happens there. Here is GDP to accelerate much faster, yields to accelerate much faster. This is from Patrick Karam, gross domestic product. GDP's 5-year rate of change coming down and breaking out to the upside. Same with 10-year yields, breaking that downtrend and breaking to the upside. We could see an increase in gross domestic product and in yields. That is the economy. And that could be, gross domestic product can go up from money printing. It can go up from actual increases in goods and services as well. I had to, guys, this one's crazy. It says, get your kids out of camps. The teacher doesn't know how to do math, and I just thought it was incredibly crazy. It took Marie 10 minutes to saw a board into 2 pieces. So it took her 10 minutes to do 1 cut to create 2 pieces. If she works just as fast, how long will it take her to saw another board into 3 pieces? Well, in order to cut this into 3 pieces, you have to make 2 cuts. If 1 cut took 10 minutes and it takes 2 cuts, it's 20 minutes in time. She's wrong. 10 does not equal 2 pieces, and 15 does not equal 3 pieces. Her math is incorrect. I just thought that was funny. This is the mortgage payment index adjusted for median income. Many people have complained to me that I should take incomes into account rather than adjusting using the consumer price index. Doing it this way actually makes it look more favorable. So this is, again, mortgage payment indexed to adjusted for median income. And we're not that high out of the system yet. We're still within the normal kind of area. The problem is we came from the cheapest time to buy a house ever in history in the late 2000s all the way to the 2010s. That was the cheapest time to buy a house. And yes, it would happen kind of in the 60s and before that. We had a spike all the way to a very expensive level in the early 80s. So everyone's comparing this number to the number that we were at. We may never go to that area. Well, we may not go to that area again for another decade plus, maybe 15 years. So I wouldn't expect to come back down here. I expect that we might come to more of an average of the 0.618 fib retracement level, is where I think. Here's Mike. He's talking about real estate as well. He says, how will the debt ceiling crisis impact the housing market? Home prices, median price of a single family home is $450,000. It's unchanged from last week and last year. expect a few weeks for a acute crisis to show up in home prices. So if we were to look at this, it says inventory, only 424,000 single-family homes on the market this week. It's up 0.7% from last week. Strong buying trend this spring. Strong buying trend this spring. If default happens, mortgage rates will jump. Buyers will freeze, but don't expect inventory to jump. Sellers will freeze too. Some will withdraw. So here's our inventory level, still at a very low level, even lower than the boom years in the late 2010s. Pending sales rates. Here we go. This is where we'll see the debt ceiling crisis hit immediately. Home sales rates will have steadily climbing, now only 14% fewer than last year. See the pendings rise versus the inventory in this chart. Crisis will delay offers and shoppers watch this stat. This is for sales. And if you look, this is homes under contract. We have a very close pending sales to that's to inventory level. We are very, very close. So it's closing the gap. Now we're only 14% fewer here between the dark and the light lines there. Pending sales prices will be the slowest place to adjust. Pending prices are 1.5% lower than last year. May last year still had Q1 momentum, so we're comparing to the peak. If the showdown isn't resolved, it could take 2 months to see it in home sales prices. Price reductions currently 29.9%. At the pandemic lockdown in 2020, we all assumed that the real estate market would tank. But very quickly, the lack of price reductions was a signal that it was not. Buyers were buying. Many people hung on too long to the assumption of a pandemic crash. So that's what we've got for housing. Saudi Arabia continues to walk the walk and lead by example. This is cargo volume of oil. Look at it go down, guys. They are cutting their supply. This supply takes time, or the lack thereof of supply, is going to take time to hit the inventories in America because it takes time for those tankers to get to us. Expect this to hit in June, middle of June. So get ready. Here we go. Where are we going? I just skipped out of that for some reason. We're coming back down. So here's one. It says, if you're in your 20s, learn these financial rules to become a millionaire in your 30s. So here's 3 principles. This is the foundation of it all. Increase earnings, decrease your spend, invest everything left over. So increase your earnings, decrease your spend, invest everything left over. So what I'm going to say here of what I would do in my scenario if I wanted to increase my wealth even faster. I would buy a house. I would rent out the rooms in the house to my friends in my 20s, and I would charge them rent. If you had 3 friends that you knew that would treat the house okay and that you could charge them rent, you could charge them $800 a room. That's $2,400 a month, and they would pay off your mortgage, which would hopefully be around that price. Your living expenses would be $0 to live in that house, and all you have to do is cover the maintenance or whatever else in the house. You are also increasing your earnings or cash flow by renting out those rooms. You're also living in the house, which decreases your cost, and you can oversee the house of it being properly maintained and not being destroyed. You would decrease your spend and increase your earnings or your cash flow by doing that one example that I just told you. And then you can invest in everything left over. And what I would do is I would invest in things that you have control over. Anything that you have control over, a side hustle, a second job, maybe getting a promotion at your current job. That is what I would focus on. It would be increasing your earnings and using your leftover money to cycle back into things that you can control. As you get more and more earnings left over, take those earnings, in my opinion, and what I would do if it was me, I would put it into investments of everything that was left over that was sitting in a bank account. Obviously, I'd have 6 months, 8 months of savings in case something were to happen, or maybe even more than that, depending on how much you make. And I would invest in what I would see are the best value in the market. I'd get dividend paying stocks. I would take a conservative approach in the beginning, generate more cash flow with the dividends, and then I would start hitting up more of the speculative stuff later on to swing for the fence, to put you over the big accrual of we'll say the big earnings. Hitting for the home run is what I would do last. But that's how I would do it. Buy a house, rent out the rooms, increase your cash flow, decrease your spend, divide up your utilities amongst everybody, so you really decrease your costs. I would increase my income as much as I could, do a side hustle if you have to, increase in investments and dividend paying incomes, which then increases your cash flow again, and continue to invest and invest and invest. But that's what I would do. And I would even do it in this market today because inventories are low. If you can find a deal. And here's something too. This guy said, what if you had no debt and $100,000 in investments? Well, my question or statement back would be, well, what if you had debt and it was in a house and you increased your cash flow with that debt? That would be a smarter move. And you don't necessarily need 100,000 plus in investments. You could put $100,000 as a down payment. Say you've got 120,000. You have $20,000 in savings just in case something happens. You put the $100,000 down. You buy a house, rent out a couple of rooms. You increase your cash flow, decrease your expenses, and then start working on building up the investments even more on that side, and try to increase your income as much as possible. I am not in the camp under these market conditions, and I think it will last another 10 years, is my guess, where rent is going to be incredibly expensive. And rent is going to increase. So I would lock in my costs early, get some renters, rent some rooms out. Even if it was just 2 renters, I'd still do it. And I would lock in my costs in an inflationary environment. But that's me. That's what I have done with mine. I bought in the mid 2010s and locked in my cost. I refinanced because I had the option to refinance, and I refinanced my mortgage. My mortgage, guys, is incredibly low. And having and using that debt and the way that I used it is more valuable than that 100,000 plus in investments. Now, I've got a lot more than that in investments, and I'm using debt as well. I think that locking in your costs at a very low rate is something that I highly prioritized in my in growing wealth for myself. I am a millionaire in terms of my asset amounts. I don't know my exact number. I know it's definitely over 1 million. I don't know if it's more than 2 million or not. I'd have to go back and actually know how much I have of everything. But you look at this, and one of the biggest things for my success is locking in my costs. I want to lock in everything I can as low as I can. And you can do that with your living expenses. You can't do that if you have no debt. You have 100 grand and you're renting. You still have variable costs, and you're still subject to future inflation pushing asset prices up for home prices. Now, I don't know if home prices will 100% go up. I don't know the future. No one else does. These guys that are making housing bubble predictions, they don't know the future either. But I would be very weary of a housing market bubble prediction with no inventory. That just hasn't happened in history. Yes, prices can soften. Yes, they can come down, especially in certain markets. But overall, we are underbuilt. And generally speaking, what we've seen in history, even when interest rates go up, and generally interest rates go up in underbuilt scenarios, when we're underbuilt, house prices go higher and new home sales go up, increasing the inflation in the system. Here's one for SRS Rocco. He says, because the global economy is driven by oil, not finance, which I do agree with, we have just begun to experience energy cost push inflation. Economists are totally clueless about energy as the main driver of the economy and inflation, even though the money supply makes a bad situation worse. Now, it's actually both of these. And it's not the money supply in its aggregate, it's the money supply that's being circulated in the system. So it's money supply being circulated in the system in relationship to the oil supply that is providing growth for gross domestic product. And here's the two, the CPI 12-month change in oil price, and you can see they're directly linked. The reason they're linked is because oil is the number one inflation-sensitive asset or commodity. Oil is the transfer mechanism of oil into the consumer price index. That's the transfer mechanism of money in the system being transferred into the consumer price index. It has to transfer through oil. This is, we talked about this before, so I don't need to go into that. But I'll end it there. We're at 26 minutes, so that's what we've got for today, guys. I know a lot of people in the comment section talking about housing, and I know I am still in the camp that we're not just going to have this big housing market crash. I got to see inventory levels go up. I'm in the camp that the housing market is actually tight, and that we could see new home prices go up, even in the face of increasing interest rates, which I've said that before. The rate of increase and how fast it happened did slow down the markets, and they will slow down the markets. Where we go from here, we'll have to find out. They're going to have to continue to increase interest rates and try to slow down the market, which is in a deficit, which is underbuilt, and a demographic coming into home buying years, which is larger. That cohort is larger, the millennials, than the baby boomers. The baby boomers had more kids than what they did themselves. So they had more than 2 kids on average. So that cohort's it's quite a bit larger, actually. We will see deaths from the baby boomers come into play at some point, and things I still think won't equal out for a period of time. It's going to take some time. So we could still have a few years before all this tries to equal out. We also have immigration coming. So we'll see what happens. If the inventories remain low, I think that's going to add pressure to the upside. If inventories start to stack up, then that other portion is correct, and will eventually start to turn in the overall markets whenever that happens. It just hasn't happened yet, in my opinion. So that's what we've got for today. Thumb up for the content, subscribe to the channel, and subscribe to the website if you'd like. And we'll catch you guys later. This is Finding Value.